So in this video, I want to discuss with you the importance of looking for specific technical sell signals on the chart of a particular stock, especially when the market conditions are weak. So let us look at the example of a company called NetWeb. I had rejected this stock back in September. So have a look at this NetWeb. It's a complete collapse. But somewhere during September of 2024, I had rejected the stock because if you see on my YouTube channel, if if I go to the search bar, I just type NetWeb here. My YouTube channel is like a trade journal for me. Okay. See, average daily volume in NetWeb is not satisfactory. This was 4 months ago. So maybe in September, I had rejected the stock. You see this rejection sign here. So somewhere around this area, 17, 16 September, I had rejected because on that day, the average volume was 166K. And as you know, any stock which has an average trading volume of less than 200K, I'm uncomfortable buying that stock because it doesn't have good volume. So liquidity analysis is a very important uh, aspect of my orange trading system. Remember that orange trading system that I discussed few videos back? Here it is. Okay, is how looks like. Just a second. So in this, the 5 elements that you see here, liquidity analysis, comparative analysis, technical analysis, fundamental and market analysis. So in September 2024, when I was looking at NetWeb, I had rejected the stock because of liquidity reasons. I wanted more than 200K volume. And why was I interested in the stock in the first place? Because if you look at Market Smith, let's go to Market Smith and let's look at the numbers of the stock. Okay. So I write here NetWeb technology. So I was looking at it around middle of September. So have a look at this. I click on consolidated. See, you see in June, the EPS growth was 174, sales growth was 150%, triple digit sales growth, triple digit EPS growth. Okay. And that too accelerating. So 12%, 162%, 174%, 42%, 150, 15%, 150%. Okay. So when I am in middle of September, the September quarter earnings are not yet announced. So when I'm looking at the stock in the middle of September, I'm only looking at June quarter earnings, correct? So when I was looking at the stock in this particular area, that is middle of September, I was looking at this number. This was the latest reported number. Okay. That is why I was excited about the stock. Moreover, March 2024, the year ends. So have a look at the annual numbers. From 1.62 to it goes to 4, then 9, then 13. So positive growth in annual EPS in each of the past 3 years, right? So EPS excellent, sales growth excellent, quarterly, annually, no problem. This was the reason why I was interested in the stock. Return on equity 18%. So if we look at this, fundamentally, it was looking very good. Technically, it was forming a base. Comparatively, it should have been good. Otherwise, I would not have looked at the stock. So the only reason I rejected the stock at that time was liquidity concerns, right? Another reason which I remember I had rejected the stock is because if you look at this, the sector, okay, I open this. When the sector page opens and I click on stocks, this is the only stock in this industry. See, computer software database. So let's go to industry groups. Let's go to computer software database. Okay. I scroll down. Computer software database. See, number of stocks one. Okay. So, which means uh, it's not a market leader. It's as simple as that. You need some, at least some stocks in the industry group, right? And by the way, this particular concept is mentioned in William O'Neill's book, How to Make Money in Stocks. He says that if the industry has got very few stocks, or maybe two or three stocks, and then out of those two or three, you're looking at the top stock, probably you are not looking at a leader. That is what William O'Neill has said. He did not say it exactly the way I am telling it to you now, but if you read his book, somewhere in some chapter, he has mentioned about this problem of one particular industry group having very less number of stocks. That is not a market leader. And if you look at the market capitalization of the stock, is 10,000 crore, is no big deal, right? Sales of 1,000 crore annual, no big deal. There are companies that sell like 25,000 crore per year sales, right? So this is very small cap. Okay, it's not a big deal. Okay, so it is not a leader. Plus the liquidity analysis, it did not fit my criteria from the orange trading system. So that is why I had rejected the stock in September. But I kept an eye on the stock. Look what happens. Yeah, let's go to trading view. I rejected here. I kept an eye on the stock because it was showing up in my filters, maybe because of comparative strength. See, by the time it reached in this base, the volume had already increased to beyond 200,000. So now I am interested in the stock. But then something interesting happened. The EPS growth gets announced. Have a look at this after September. September gets announced, it's 68%, right? Less than half, correct? Less than half of the previous quarter. So the EPS growth has fallen by more than 50%, correct? Even the sales growth has fallen by more than 50%. The growth has fallen by more than 50%. Correct? 174, it goes to 68. Sales 150% growth, it goes to 73% growth. That's a problem. It could signal the top of the EPS cycle or the sales cycle of the company. So that was one cause of concern. Because if you remember, I had spoken to you about Dixon. In Dixon, what had happened is the EPS crashed. The EPS growth, although it is 122%, but compared to September 2024, it's like a crash. See, the EPS has more than doubled in December quarter. However, in the mind of the investor or in the mind of the trader, the EPS growth rate has crashed by more than 50%. Okay, this is how people think in the market. They don't see that Dixon has doubled its earnings in 1 year from December 2023 to December 2024. They only see from September to December what has been the growth rate. The growth rate, by the way, is annual. It compares the current quarter with the same quarter last year. Okay, so because of this fall, Dixon collapsed 15% in a single day, in spite of the fact that it has doubled its CPS. Look at that. Look at this candle. Okay, fundamentally very powerful stock, but one slow quarter in terms of EPS growth and it collapses like 14% in a single day. That's severe punishment for a high quality stock like Dixon. So, and Dixon, by the way, always had very good volume. So, if stocks like Dixon can collapse this much, think about what can happen to stocks like NetWeb, which did not even have liquidity volume, right? Let's go back to NetWeb. So, September, the EPS growth in September came down, correct? That itself was a cause for concern because the EPS growth rate has been declining. But if you notice, after September, the stock should have collapsed or declined or something. But after September, see, you go to October, November, the stock is holding up. Even though the EPS growth rate has declined after September, so this is September somewhere here. So September quarter gets announced in October. So in this particular area, the earnings was announced. After that, see, instead of collapsing, it continues to go up, and its volume. You look at this blue line, the slope of this blue line, volume continues to increase, price continues to increase, and it tries to form another base. And by the way, this is base number 3. Remember, base number 3 is a tradable base. Okay, it's not an investable base. By the time the stock reaches base number 3, is probably too late. Okay, base 4 and 5, the chance of failure is more than 80%, especially in a weak market condition. Remember these nuances. Okay, now it forms a base. See, point 1, point 2, I will draw the base for you. So this is point 1. That's 0.2, that's 0.3, that's 0.4, and that's 0.5. So nice base. So let's look at 17 December, right? I did not take a trade on 17 December. See, where is 17 December? Here. What's the relative strength on 17 December? It is 79, which means below 80. I normally hesitate to buy a stock with a relative strength of less than 80. So definitely 79 is a cause for concern. Plus, at that time, I must have definitely been looking at industry rank. Industry rank is 155 now. I did not know what was it at that time, but probably the industry group rank at that time was more than 40. So two negatives. So it did not fit my comparative criteria, right? The industry group rank is more than 40 and the relative strength of the stock is less than 80. Probably that is one reason I rejected the stock. Another reason I could have rejected the stock is because only one stock in the entire industry group. So it doesn't really belong to a particular industry group. So definitely, I don't remember why I rejected the stock on 17 December. On this day, I have no idea why I rejected the stock. But when I look back at what happened, I probably must have rejected the stock because of comparative reasons, because of relative strength, industry group rank, and industry leadership. At that time, liquidity was not the problem. Probably market conditions is something I must have looking at while I was looking at the stock. Technically looked good. Fundamentally, there was a problem because the EPS growth rate had declined. So that must have been one reason why I had rejected the stock. I should have made a video on NetWeb, but I don't think I have made a video. I checked my YouTube channel. But one thing I know, I never bought the stock. And uh, fantastic decision. Thank God I did not buy the stock. But let's assume that I bought the stock. Okay, let's assume that I looked at liquidity analysis, fine, market is fine, technical analysis, fundamental analysis, fine. Let's assume that for some reason, I overlooked the comparatives, I overlooked industry leadership, and I bought the stock. Okay, so here is what I want to teach you in this video. A stock before collapsing gives you some specific technical sell signals, and if you are not alert to those technical sell signals, you might end up losing big on the stock. So let's go to this. This is 17 December. Okay. Wait, let me check what is the distance between the closing price and the yellow line. That could be another reason I had rejected the stock. From closing, yeah, see, now I got the reason why I rejected the stock. See, the 16 December candle from the closing price to the yellow line, it was more than 5%. My criteria is from the current closing till the yellow line, the distance should be less than 5%. The smaller the distance, the better. So that is the reason why I did not take a trade on this day. So the stock failed in technicals. Okay, it must have also failed in comparatives. I can tell you from that just by looking at some numbers. So it failed in comparative, failed in technical. I think fundamentally there was a concern because of that decline in EPS in September. Market, I don't think market was a problem at that time. Liquidity was okay because the stock had gone above 200K average daily volume. So now you understand whatever I am doing, it all comes back to this orange trading system, okay, which I explained, discuss in detail in my video course. Each of these elements, see, there are nine, see, 5 plus 4, 9 plus 1, 10 specific elements you see on this orange trading framework, which I discuss in detail inside my video course. Okay, so have a look at my video course. So comparative, technical, those are the two reasons I must have rejected the stock. But as I said, let's assume I bought the stock. Okay, for some reason I bought the stock here. Look what happens in the next 2 days. Wait, yeah. So if I just hide this, yeah. Have a look at this. So I buy the stock on 17 December by overlooking certain key signals. Okay. So buying itself is a wrong decision. Let's say I take that wrong decision. Okay. Look what happens on next day and the next day. What is the low of this candle? 2911. What is the high of this candle? 2906. Do you see a falling window? Do you see a downside gap between these two candles? Falling window is nothing but a downside gap. Do you see a downside gap? How many times have you listened to me speak about the dangers of a falling window? Right? Countless times on my YouTube channel, I have told you whenever you see a falling window in a stage two uptrending stock, please run away from there. Okay, that is not the right stock for your portfolio. The stock does not deserve a place in your portfolio. I sold Zomato because of the falling window. I sold Dixon because of the close of the rising window. Okay, look at this falling window. It was a clear sell sign. So on this day, on 19 December, 5 minutes before the close of the candle, I would have quickly realized that this candle is creating or completing a falling window. Okay, the fact that it is completing a falling window is a clear sell sign. So assuming I had bought at yellow line, I would have lost roughly around 5.5% if I had taken the signal given by the falling window. Now, if I had not listened to this signal of the falling window, okay, if let me draw a line here for you to just show you that falling window. See here, and the high of this candle is here. So that's the falling window. Okay, you see the gap between these. Doesn't matter whether the gap is small or large. Falling window is a falling window. A window is a window. A window becomes resistance. Falling window becomes resistance. Rising window becomes support. Okay. So if I had not listened to that falling window, okay, look how much I would have lost. And trust me, people have lost that much money. I have received calls from some of my YouTube subscribers who had held on to the stock in spite of the falling window, held on to the stock even if it broke the 50-day, even if it broke the 150-day, even if it broke the 200-day, people were still holding on to the stock. I have received call from my YouTube subscribers. Okay. This is the reason why I am very passionate about making this video to help you realize that any stock before collapsing, it gives you some specific technical sell signals. The sell signal came on 19 December. We are talking about 27th of January. Look what has happened. If I had not sold here, anyways, I'd never bought the stock. So the question of selling doesn't come. But if I had bought and not sold here, imagine how much I would have lost. 50% in the stock in just a matter of like a month. 1 month minus 50% return, that's a complete collapse. And do you know why this happened? Do you know why this happened? At least pay attention now, right? 174%, 68%, 13%, exact reverse of December, March to June, exact reverse is happening. Okay, declining 3 straight quarter declining EPS growth, 3 straight quarter declining sales growth. It's a clear sell signal, right? William O'Neill says that if the earnings decline by more than one third from quarter three to quarter latest quarter, if the earnings decline by more than one, if it becomes one third or less of this amount, that's a disaster. I mean, it's a clear sell sign. So one third of 150 is what? 50%. Okay, if this is number is below 50%, that's not acceptable. It's too much of a decline. If it goes down like 25%, 50%, that is fine. But if it drops more than 67%, like going below one third of its value, that's a red flag. And by the way, all of this is written in William O'Neill's book. If you don't know what I am talking about, that means you have not read his book. Okay. And all of this knowledge, all of this platform, I learned from William O'Neill. I'm just simply applying that. It's not my some pioneering original rocket science knowledge that I'm using here. I just studied from someone who has studied 100 years of stock market history. So I just learn from him and apply and see how much losses I have avoided, how much pain and how much headache I have avoided for myself by just paying attention to certain specific signals. Look at fundamentals, look at technicals, look at falling window, look at moving averages, look at EPS growth, look at sales growth. The stock gives you signals before it collapses, right? It's evident here. I have proved it to you. So you don't have to endure this pain. Another one of my YouTube subscribers called me and asked me that he has been holding on to DOMS Industries. Okay. He called me when the stock was somewhere here, if I remember correctly, somewhere here or here. He called me because he did not know what to do, because he had been holding on to the stock for a long time. Okay, somewhere over here. Have a look at this candle. Have a look at this candle, 19 December. Right? On 19 December, there was a falling window. So this candle was a clear sell sign. Correct? On this candle, the stock should have been sold. So, assuming he bought the stock somewhere here, he must have been making money on the stock. If he had if he had taken the falling window signal here, he should have been out here so that he doesn't have to endure this much pain. See, the stock has collapsed 28% from that level. It's a clear sell sign, and I credit Steve Nissen for this. Steve Nissen is my original mentor, even before Mark Minervini. I had studied from Steve Nissen. Steve Nissen says falling window becomes resistance. Read the Japanese candlesticks charting techniques written by Steve Nissen. Very, very fantastic, very, very interesting book. He talks about the falling window becoming resistance. If you have spent any time on technical analysis, maybe 6 months, 1 year, by now you should know the importance of a downside gap or a falling window. Okay, it's extremely bearish. And by the way, today, as we discuss, today is what? Today is, what is the date today? 27th of January. Okay, look at Nifty today, the index in India. Do you see a falling window between these two candles? Right? What is the low of this candle? 23050. What is the high? What is the high of this candle? 2307007. That's a falling window. Extremely bearish sign. Do you see a falling window on Nifty here? Do you see a falling window between these two here? Look what happened after falling window. Do you see a falling window here? Look what happens after a falling window. Right? So I cannot stress the importance of the bearish signal given by the falling window. These are specific technical sell signals that you have to pay attention to if you want to avoid catastrophes like this. Okay, so pay attention. Pay attention. DOMS Industries was, there was a falling window. I think in Newgen also there was some signal given. See, falling window. Latest candle, there is a falling window. Right? Complete collapse in the stock. By the way, I did not buy here. Why? Because this base 5, late stage base, weak market. We don't take a trade in late stage in a weak market, right? Look what happened. People who bought here lost everything. Pay attention to specific technical sell signals given by the chart. The chart gives you the first signal. The fundamentals come later. Technical is more important than the fundamentals. So that's what I wanted to cover in this video. Any stock that has collapsed definitely has given some or the other technical sell signal before it had come down. Okay, and NetWeb is a perfect example of that. So the falling window was the signal given by the stock inside the base. Just because the volume has gone up doesn't mean that the stock will go up. Look what has happened to the stock. Today, the stock has collapsed 12% with a falling window, which is even more bearish. Okay. Thank you so much.